Good evening, everyone. Thank you so much for joining us once again. My name is Margaret Businje, and it is my honor to welcome you again to this session of Financial Literacy and Money Matters. So tonight, we will be discussing a highly requested topic, the ideal retirement solution. As always, we request everyone to be a good participant. Together, we'll explore the best financial strategies for a secure future. So tonight, as you saw on the flyer, we have a great speaker, Mr. Herbert Diego. We'll give him the floor to take us through what he prepared for us. But again, we ask you to mute your mics and we'll open for discussions at the end. Thank you and welcome to this great discussion. Mr. Herbert, the floor is yours.
Awesome. Thank you, Immaculate. It's always a pleasure of mine to be with you here to share and learn with the team and with the guests, if we have any. The topic for tonight is a pretty amazing one. It always catches my attention and turns me on every time I think about retirement. Not sure, maybe because I'm nearing retirement that fast. Back in the times, I used not to mind much about, this retirement thing. But just like I like to tell most people, in 20s, yeah, you hear about retirement here and there and just keep going. And in 30s, yeah, you kind of ask people, well, what is that? And then in 40s, which is where I am, then you kind of learn more about it. In 50s, you kind of start getting stressed about it. In 60s, you get hit with it. So that's the path. Depending on which level you're on, the best way to anticipate retirement is to start early on, as early as in your childhood. If you're lucky enough to have parents who are financially literate, then if you're not, just like most of us, then you get to pick it up yourself wherever you're lucky enough to find more about it. So tonight I'm going to go ahead and share my screen. We're going to dive deep a little bit more about the section of retirement. As you remember, most of you we have had discussions here about IUL. And to be really precise, the portion we're talking about tonight here is one of the elements of IUL. We'll get more into that, but retirement is a component. I remember, I think one of my colleagues, financial professional, I think Dominic or someone, did make a presentation here about the three components of IUL in one slide. It's a very beautiful colored presentation, one slide presentation that has IUL in three portions, and most of you have heard about it here. If anything, we're going to dive deep into one section of that and look more into the aspect of living too long. That's how retirement comes in. If you're blessed enough to be, if you're blessed by living a long life and get this longevity of getting to 190s and 80s, you get to find this concept of retirement planning really handy and relieving in those years. So as you can see the topic right on the screen, you can see my screen, right? The topic on the screen tonight is ideal retirement planning and long-term financial security. Let's take it this way. The agenda is going to be pretty much as it's, yes, retirement more, but those 4 points, if I may say, 5 points, we'll talk more about the where people save money for retirement and the smart rules of money. Then we're going to touch more on a high level about the two phases of retirement money. The ideal retirement plan, for sure, now that we understand the smart rules and the phases, now we'll get to see what is the ideal way. And last, maybe you can touch a little bit on the IUL and the four P's of money and how all that plays into what we do here at FEG and whatever we do in our financial professions. So to start with, let me introduce you to this point of where people save money for retirement. Let's look at maybe if you can be really participatory here. Where would you think people take their money? In interest of time, I'll just ask these questions as you answer them, then I'll just keep going at the same time. We have the taxable accounts. These are taxes. Taxable accounts are where taxes are due immediately when you gain any portion of money. They tax you. These are examples of those are CDs or money market accounts, mutual funds. You can think of savings accounts. You know, when you have a banking savings account in a bank, at some point you see, especially in financial credit unions, you see they send you like the 1098 forms of, you know, tax declaration as to how much you gained on CDs or on these savings. If those savings accounts pay interest, they give you interest, and then they give you this 1098, 10 whatever form to, you know, include in your tax returns for tax purposes. So they tax them right there and then. And then we have tax deferred. This is where now taxes are to be paid later on. Right there, we say taxes are due when money is withdrawn, when you take the money out. Examples of those types of accounts are 401ks. We have traditional IRAs, individual retirement accounts. We have also the tax advantaged accounts now. The tax advantaged accounts are situations where funds with after-tax dollars. So there are no tax dues on gains or on distributions. Think about that. On the first one here on top there, on taxable accounts, you pay taxes right away. And someone comes to you and say, oh, no, I've got a better way to kind of defer your taxes and pay them later on. Okay, you find that one great. Let's go into 401ks and, you know, take money when we're 59 and a half and later, maybe 60. The third piece here, the tax advantaged accounts, that's where I believe everyone would want to be, where you have no taxes to pay on all your money that you set up for your retirement. Examples of those are Roth IRAs, your cash value life insurance policies, IUL. For a matter of this discussion tonight, we'll dive deep into a little bit more on IUL. And then we can now go into the second subject of the smart rules of money. By the way, from the first piece here where we're talking about tax, you know, taxable accounts, deferred taxable accounts, tax advantaged accounts, all those, by navigating them and learning about them and, you know, playing the game, you're trying to play the game in a more smart way. And what we mean by saying smart, well, in operations, smart means something completely different than in financial industry, financial profession here. I think the old slogan of SMART, they say something like simple, measurable, you know, when you're setting your goals. But remember, this is rules of money. It's not goal setting. In goal setting, SMART will be simple, whatever, measure, time, thing. But in finances, in our industry here, when we say the smart way or the smart rule of money, the S and M there and ART would mean something completely different. So S for smart will be strategic. Then management, around retirement taxation. Now, let's take that one for a minute. If you can find a strategic way to manage your funds and beat the game of taxes in your retirement times, then you're smart. That's what we're talking about tonight here. So everyone's going to be smart tonight, right? Good. Let's see how we go about it. Now, remember, our topic tonight is retirement. The retirement money has to be safeguarded have to be played safe in such a way that if we can minimize taxes, if we can, beat the tax game, then we're smart. Let's see the two phases of retirement money under normal circumstances. Money for retirement has to go through at least two phases. Now, you can develop these phases into 4, 3, 5, but on a large scale, you would, condense all those stages into two main ones. The first one would be accumulation phase. And in the accumulation phase, that's where we have the idea of deferring the taxes. Now, the tax keeps accumulating, but they are deferred. Remember, you're already in retirement. They say you're in 401k. Once you're in 401k, then you pay their money, and they say, no taxes for now. You pay when you're 59 and a half and later on. Sometimes you may be able to get your money out of 401k, but then you get penalties. So if you don't want to, go into that kind of mess and around and losing money, okay, then you're disciplined enough to wait until you get into retirement, but still they tax you. So the best way to beat that game of being taxed later on, even then, is to learn what we're going to learn tonight. But this is the blueprint of what retirement money goes through. Then we have the distribution phase, which is the second phase. Remember, we said about two phases. In the distribution phase, that's when now you're taking that. In accumulation, you're contributing your money, you're saving your money, you're investing whichever way you're using, but you're trying to accumulate that money to a point where it will grow into something meaningful. And then in distribution, now you start accessing whatever you accumulated. So the most of that stuff that happens in accumulation is supposed to be a tax-free income. That's basically income. If they tax you or if they don't tax you, it's still income in distribution. So what do we have here now? Tonight we're talking about the ideal retirement plan. Remember, we've talked about these two phases. In the ideal way, for this retirement plan to be really ideal, you have to ask such questions like, what would you want to have in your ideal retirement plan? And this is what we're trying to answer tonight. How can we make it ideal? How should we set it up in such a way that it becomes so ideal? Around the taxes. Remember, the whole concept of ideal is smart. So remember, that's the whole concept we're talking about tonight here. How do we position ourselves that we manage our money around not being taxed in retirement time? So the question now on the screen says, what would you want to have in your ideal retirement plan? Now, these are lots of different questions. You can say, would you want to have interest growth potential to keep up with inflation? Remember, there's a lot of inflation growing up here and there from time to time. Maybe nowadays it's a little lower. Who knows where it's going to be, in the next couple of years, or crazy levels it's been in the past. The other question you would see, would you want the interest growth to be tax deferred or currently taxed in your ideal retirement plan? All these are questions we should be considering when we think about our retirement money. The third one, would you want the principal as well as the interest growth to be protected from risk or at risk in your ideal retirement plan? So if we can address most of these questions and know exactly what you want, then you're slowly onboarding into an ideal path. The fourth part will be, let's actually do most of these. The fourth, fifth, and sixth. Would you want the retirement income payment to be income tax-free or taxed? Of course, everyone will say, tax-free. The fifth question there, would you want your retirement account value passed to your heirs preserved tax-free or taxed? That's in case you're gone. But sixth question there, would you want to have liquidity at any time without any restrictions? or at any tax consequences when receiving money out in your ideal retirement plan. So these are all critical questions, and they can go even more and more. The seventh one there, I would add on, would you want to be free of any limitations as to how much you can put in your ideal retirement plan? So these may seem to be more long questions, but they all come around what is ideal? What is, how do I beat the tax game? Uncle Sam is always ready, be it when you're young or he gets even more serious when you're in your advanced age. Because, $1 or $100 in your advanced age becomes like say 1,000 or 10,000. $1 today rather, it becomes 1,000 in your advanced age, or 10,000 for $100. Now, the next phase would be, how does this IUL that we've talked about initially match up to your ideal retirement plan? Remember, we are now aware, I don't know, for most of you, I see most of you here have been here before. We've talked about the three components of IUL. There's the insurance part, there's the cash growth, which is embedded in insurance, but also addresses the second piece, which is the retirement planning. The cash growth aspect in IUL is meant to address the retirement piece. And then we have the living benefit side. I've always loved that one slide presentation that has, a summary of all of it. I have it here, maybe for the sake of what we're talking about here, I should be able to put it up. But let me actually show it to you here, guys. Here's what I'm talking about. So we have basically IUL all in one. So the point I'm talking about here is living too long. This green part, living too long. This is where retirement comes in. And on this slide, we are literally dissecting. We are going into all parts of IUL. IUL has three main parts. The green part, this red part, which is death. Now, the red part is more about life insurance. The green part is more about retirement planning.
Sorry to interrupt. What does the IUL stand for?
Oh my, that's a good one. Thank you so much. And my apologies, I should have actually spelled it out. Thank you, Regina. IUL is actually in insurance, in index universal life insurance. It's a type of insurance that is based on index. You get interest based on indexes on the stock market. So we have a downside risk protection. When the stock goes down, you're protected not to participate in the losses. But when the stock goes up, you gain with the market in your life insurance policy. So I think we just, at this point here with this question, the best way to address it is to go a little bit back and say there are lots of types of life insurances. It could be a whole life. It could be a universal life. It could be a term. And those are all, deep concepts of life insurance, but on a very high level, term is limited on time. It could be 1 year and it expires. It could be 10 years. At most, it can't go beyond 30, 35 years at most. Just like you take a mortgage. You can't get a mortgage in the market of 40 years for payment. No, they cap it up at around 30, I think. They can give you 20, however long you want. But once it goes to the highest, they cap it out around 30 years. So even with term, they can go around 10, 20, 15 years, but it can't go beyond 30 years and it expires. So it's like you don't have insurance at that point. You can renew, but renewing becomes a whole different ballgame because now they renew you as someone who's 30 years older than the times you started. So that's one piece. Then there's a whole life. Whole life, you pretty much have fixed small interest that goes in your cash value. Matter of fact, term has no cash value at all, not even a single penny. When we say cash value, we talk about the premiums you're paying monthly. A portion of that premium goes into your savings account, so to say, savings account. And another portion goes to cover your life in case you die or something happens to your life. So that's how now we start talking about cash value, interest, accumulation, whatever, and death benefit. So if I can show you on this screen here, term policies of life insurance, the ones that are term, they only address this red portion, death. When you die, be it too soon or too late or whatever, term addresses death alone. But then we have other products like, whole life that, starts the idea of saving a little bit of money that you pay every month or every year into some type of a savings account where they're going to allow you to access that money later on if you're still alive. That's how now we're trying to address a second piece of this green side, retirement. So the smart folks, the gurus of finances and tycoons, most of them use this concept of IUL to keep money and avoid taxes and, do that in disguise or in the name of protecting their life, and go hard on this green side than the red side, even though it's called life insurance. And then we have a third portion here, which is the getting sick. Now, when you get sick during life insurance, now we are addressing the idea of living benefit. Look at the red side. It says death benefit. Now, with the yellow piece, it's no longer death benefit, but it's living benefit. You're still alive and you still benefit that life insurance. Those are cases where, you get sick, you get a portion of that life insurance amount, whatever, the death benefit that is in the life insurance, you're able to access it. If you get sick, not just any sickness, but a specific illnesses like those chronic, critical, and terminal illnesses, as you can see here. Is it making some sense a little bit for you, Legina? The idea is that tonight we are more focusing into this piece of living too long, so to make the point of retirement. And you can grow your retirement money through life insurance product. And the way you do that is what we're talking about tonight here. So my piece, I wanted to bring you to this attention of this slide because it gives a high level of index universal life or on a 30,000 level view. You see the whole three components of what is in IUL. And for tonight, as I told you again, we are focusing on the green piece. How do you set your money up into this green piece using these three pieces of information that I shared there? There's indexing, that's what we do in IUL, which is not in any other types of insurance. Term doesn't do indexing, whole life, does some other stuff of saving with fixed interest. But indexing is the point of protecting your savings from loss and providing you the upside potential of the market. Then we use the rule of 72. Now, the rule of 72 is a pretty old concept in finance, but it's still new, very, very new and complicated to most people who are not in the field. But the rule of 72 is all about putting a compound interest idea on your money that you're contributing to work for you. The interest now is working for you in a sense that you earn the interest instead of paying it, because there's no way in between. You either pay interest or you earn interest. Remember, you take a credit card, you take, auto loan or mortgage or whichever. Interest is a big, big, big term in advanced economies. In the first world, especially on the West, here in the Western side, everything has interest. So you got to find yourself on either side. Either you're paying interest or you position yourself to earn interest, or if you have to pay it, you pay less of it and earn more of interest. And the only way to earn more of interest, or even earn interest purely without paying it, is to use the idea of compound interest. And the rule of 72 gives us an idea of how much and how long you can earn those interests. But that's what is applied in retirement planning here when we're using IUL and when we're using investment vehicles. Now, the third piece is a tax-free, the situation where you maximize your tax advantages, whereby you're able to create, 2, 3, 500% more income using these techniques. Now, going back to the point that I was on earlier here of ideal retirement planning, now the question becomes, how does Index Universal Life match up to your ideal retirement plan? From where I was showing you on the colored slide there, on the green side. Now, look at this. You would want to ask yourself, IUL, or Index Universal Life, it provides interest growth potential, as I was telling you, through an index concept with the power of indexing, where you lock in gains. So whatever you lock in, whatever you gain is locked in and then resets. Now, let me kind of illustrate imaginatively on how it goes. Remember the stock market? The stock market goes, the curve of the stock market is up, down, up, down, up, 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 down, 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 up, down, and it keeps going, going back and forth like that. Now, with indexing, you're locking the up movement wherever it goes. So it goes up, and then once the stock goes down, it locks right there and waits until the stock market to come back to where it was before. And then once it goes above that line, it participates. And then once the stock market goes again down, it locks. So what we call resetting is that holding and activating again when the market is back to where it was before. Then it resets to participating again. So the curve the curve of indexing ends up being up, flat, up, flat, up, flat. So you're locking your moves to a point where you don't go down. So if I can put it in a layman language, you would say the stock market curve goes like 4 steps up, 2, 3 steps down, 5 steps up, 4, 3 steps down, keeps going up and down. With the indexing here, what we get with IUL, it goes up, then you wait, not down. You go up again, then you wait. I hope we're right together there. Awesome, thank you. Now, the second piece of what we get in IUL is the tax deferral of interest growth with compounding interest. Remember, we talked about the rule of 72 on the colored slide. Now, all those interest you're getting by the up movement, there's no 1098 that is going to be sent to you to pay taxes at the end of the year. A matter of fact, we are right now in tax, in tax return times. Most people are getting these ideas of, getting, 1098 of whatever gains you received on your bank account. For those of you that have investment vehicles. So the tax deference there on only the interest that you gained. Now, IUL number 3, it gives us a downside protection. So when you set up your policy in IUL, they'll tell you, okay, the market is you're gonna get this interest in what, and so on and so forth. But they also give you a guarantee rate. Because remember, the market is not gonna play by this rule. The market will go up and down anyway, right? The market is not going to say, no, we just have, this is IUL, so we can't go down. So if the market goes down and keeps going down, and keeps going down even further and keeps going even far down below zero, just like it happened in 2007 for those of you that were around. By the way, whoever was not around in 2007, I don't think they should be here because they may be young enough, right? Not to be 18, no. Maybe they're about 20 now, I think, yeah. So remember in 2007, we had a market crash. There was a financial crisis. The stock market went below zero and was performing in negatives, not just, simple negatives, crazy numbers of negatives. So people lost money. A lot of people lost money. I have friends that lost their pretty much life. People took their lives. Because if you had trusted the market all your entire life, like most people do, put all your savings in different, vehicles and shares and, every company literally lost money there. So people could see in their watch their money savings, not necessarily retirement. No, even retail, real estate. The prices, inflation went bananas, if I may say. So here in IUL, you're given a guarantee. And that guarantee is given in terms of interest rate that you're going to earn, even if the market crashes below zero. And that market is called, that rate, guaranteed rate, is called, anyone remember that rate here? I saw we have pretty smart folks here. Someone who is already in finance. The floor rate, that's what I'm talking about. It's called the floor rate. That's the floor, just like the floor. It's like you can't go below the floor. If you're in your house, the floor is the lowest you can go, unless you go in the basement. But in the market here, we say it's the floor rate, it's the lowest rate. So if the market goes below the floor rate, performs below that, you will still get a positive rate. Usually floor rates, depending on the insurance company, we call them carriers, they vary around 0.25. That's what, I think Fidelity provides, 0.75, 0.5, 0.525, but it's all around 0.0 something percent. Now, I want you to catch this, please. If you're getting the floor rate, that means the market is below the floor rate. The market is in crash, is in crazy, is in a crisis. Everyone else is losing money. In finance here, we say zero at that point becomes the hero. So whoever is getting zero is the best of all the people because everyone else is losing money. The stock is growing crazy negative. Everyone is losing and you're still getting this guaranteed rate. That's where we call number 3 downside protection. Now, there are levels of protection right there. Remember, it was freezing and wait until the market comes back up. But if it was to not come back up and goes all the way down, you're still getting an interest. Even if it was to simply get what you had in with no interest, not even 0.0 interest, let alone what we provide here of 0 point something, 0.5, 0.7, 0.1, that's still interest. But it could have been worse. You could have lost all the money that you have in that portfolio. So that's where we say you're protected. What is protected? Both your principal, the money that you put in, and whatever interest you had gained at that point. It's locked. You have a minimum guarantee. We call it minimum guarantee, a floor rate, but it's all meant to protect you against negative performance of the stock market. Number 4, the IUL provides a retirement income to be paid tax-free. So the income that you're growing in IUL, at a time that you take it out, it becomes tax-free, in which case it does not impact your taxes on future Social Security benefits, both on tax, death benefits. They're always tax-free, not necessarily in IUL, even in term, even in whole life, but also a portion of that interest that you paid is tax-free because it's part of the money that you paid after taxes. Those are crazy numbers that you get to dissect deep into and know how much exactly is that going to be tax-free from your interest portion. Number five, you get IUL provides the death benefit to be passed down tax-free and is paid outside of your probate code. Now, probate code is something different. Probate code is when you don't have life insurance, but you have maybe 1,000, 10,000, 100,000 saved on your bank account, or in your, or maybe say equity in your mortgage, or you have your car that you already paid off. If you don't have life insurance and you're not smart enough to have those revocable trusts and estate planned out, so with probate court, they freeze your assets and first clear out your creditors. Whoever you owe money has to be paid first, and then the remaining portion of the money gets paid to your dependents, maybe your wife or your husband or your kids. But if you have life insurance, and even so better, IUL, whatever belongs in that account, the money, the death benefit, the accumulated cash that you have in there, goes to be paid to your dependents first. Not even first, just only your dependents, because no one comes after at that point, unless your dependents chooses to pay their creditors from that money. So it's a smart way of locking that asset for the benefit of your own household. Number six, IUL provides liquidity at any point without restriction or tax consequences. What does that mean? So we have this cash value that is being grown, up in the green side of IUL. At some point, after you've started it, usually around 2-3 years, depending on, we have a situation where you can even access it right away. Those are, freedom gold, the freedom aspect with Fidelity, you can have access to your money in the very first year, whatever has been saved in there. But with gold, there's a different type of IUL there. You can access it around, normally pretty much around 3-4 years. You start accessing that money that you have saved. You can take it out, buy a car, down payment of your house, whichever you choose to, or whatever need you have at that point, you have access to that money either as a loan to yourself, you pay yourself interest back into the IUL, or as a withdrawal. You take it out and it reduces your balance in the cash value account. Now, number 7, IUL provides flexibility regarding the amount that can be paid. So you can increase or you can reduce. We have things like, even when you're still contributing, you can adjust these levels. Let's say you're paying $100 and you find yourself out of job or between jobs, then you feel this burden of, maybe $100 still too much for me, then there's flexibilities where you can say, okay, let me go a little bit down to something called monthly no lapse. You pay half of your premium and you keep your policy alive, not be lapsed or canceled out. And then as life gets better back on, you jump back into the investment idea. That's on the payment, on the premium payment side. But on accessing your money, you still can increase your death benefit or reduce it along the way. Number 8, IUL or individual life insurance provides, Index Universal Life provides tax advantaged living benefits. So if remember, living benefits are amount of money that you get paid from your life insurance when you're still alive, but just because you got sick. You may get a terminal illness, like cancer, whatever, You may get critical or chronic diseases. As long as they've been prescribed and determined by a US physician, then you take that as an order to life insurance policy to be paid from your death benefit, not from your cash, accumulated cash. Because remember, the accumulated cash can be accessed at any point once you have that money there, but the death benefit can only be triggered by either death or sickness. And the kind of sickness that can trigger the death benefit would be the sickness that falls into any of these three categories: terminal, as you can see there on the screen, or critical or chronic illnesses. Now, that gives us the benefits of IUL in terms of avoiding taxes. Now, with IUL, let's talk a little bit deeper about the 4 P's of money. And by the way, I'm running out of time here. I gotta be a little more fast. I'll have to respect your time. The 4 P's of money, IUL provides those. What's the first one? Or here are all the 4. Maybe the rest will be going deeper in each of those 4. But there's protection of your money. There's a preservation. Preservation and potential is where that money is growing. And then there's payment, where you now accessing your money in retirement. That's the phase. It's kind of a journey. With protection, you're paying those premiums, and that money is put in these safe, accounts and indexing vehicles and strategies of indexing and stock up, down. That's all a path where you get your money back with no taxes or at a very minimal tax risk. So the rest from here on would be going deep into what is in protection, what is in preservation, what is in potential, and what is in payment. If I can look on a very high level, quick speed here, in protection, we have a protection of your both principal and interest. Because remember, you're growing money in there, so you have the principal of the amount that you're contributing in there, and you have the interest that you're earning through this compound strategy of getting interest, and that interest getting you another interest. So the protection comes around protecting both your principal and your interest. So there are lots of languages there. Please allow me again to be so fast here, because I went too deep into most of these ideas early on. But to respect your time and allow you guys to do some quick Q&A here, I'll just move on to the other one. That second piece would be pretty much preservation. So for preservation, we're looking at preserving your assets. And now that you have those principles, those interests in place, the IUL is going to have now to accumulate it into now assets for those of you who do not like to lose money or do not like to participate in the stock market because there are losses and risks and stuff, or if you simply like locking in gains and your returns, or you like the upside, potential, you don't like to participate in the downside side, potential of the market. Now, with the potential, which is the third piece, what do we have in there? There's a gross that is tied on index, as I explained there, but it provides the higher potential. Yes, there's a cap in IUL, a cap on how much you can earn in interest, but still remember, that cap is not necessarily bad because it's offset by the guarantees on the floor. So on top, you're given a cap, and on the lowest side, you're given a floor, and you operate in between those lines. Then we have, idea of locking the whatever is accumulated into your account. There's really great language in the potential as well. The last piece here would be payment. In payments, we have the person now gets, most of their assets, which is their income, and then you get the living benefits if you get sick along the way. Because getting sick is more common in retirement times. It becomes more common because your body is weak. It's more susceptible to diseases here and there. Now, you're able to start getting that death benefit when you're still alive. That's when we call it living benefit. And then it's tax advantaged because remember, once you touch that death benefit money, Even though now IUL covers 3 what ifs of life. Remember, I showed you these. These are the 3: a death, which is a solution of, which is solved by life insurance; living benefit, which solves the risks of sickness; and retirement planning. Now, I have come to the end of my session, and I would like to summarize it this way. With IUL, you have you have the best of both worlds. You have the best of, retirement, and you have the best of pre-retirement when you're still young even. You have the idea where you are very stable with your guarantees, with the guarantees that you receive, with the safety that is provided, with the flexibility of premiums and benefits. You can flex your premium, which is very, very rare. If you're on a term policy or whole life policy, once they lock you on whatever amount, 200 per month or 300 per month, you're locked on there. If you go down, you're risking losing the whole thing. But with IUL, you can go up and down in your premiums depending on, they give you, up to a certain time. And then there's liquidity there, which is tax-free, or you can even access your cash value, money to, pay your whatever needs. So at that point, we say the upside earning potential with the stock market has returns, and those returns are hedged from the downside risks of the market, which we call the downside protection. My summary here is these 3 rather green 5 points, 6 actually points that I showed you. The zero downside risk, upside potential, annual lock-in of interest gained, income tax deferred growth, income tax advantage retirement cash flow, strong death benefit. Why do we call it strong? If you determine the amount of money that you get from death benefit, let's say if you illustrate and say $100, how much are you going to pay me on death benefit? It tends to be much more than what you would get on a normal whole life. And then the last one is tax advantage living benefits. I'm cutting it off here for the sake of time. Thank you so much. Let me pass the floor back to our moderator tonight, Ms. Immaculate. Thank you.
Thank you so very much, Mr. Herbert. This was really amazing. So open up your mic. This is our time. Open up your mic. You might have a question. Might have something you want to add on. This is your time. Please take it on. Or if you want to write in the chat as well, that is an option as well.
Hi, this is Regina. Thanks, Maclean. Thanks, Herbert, for really great discussion. But I have additional question. You're talking about all these benefits, but you didn't mention in terms of cost. How much does it cost to buy either of those policies recommended? And one thing I want you to bear in mind, there's some folks who couldn't attend today, but they gave me questions to ask. And one of them was that they moved here about 2-3 years ago, then their mid-50s. And as you know, getting started in this country, it's not that easy. Some people work at minimum-ish jobs, and they're definitely behind their retirements. What can they do, and what would be the best way to start, to get something started, however small it could be? So I want you to answer that question, bearing in mind that there are many people in our community with different income levels, depending on what you do, depending when you got here. So I want you to give that many options, if possible, so people can find themselves wherever they are with their own income. Thank you.
Awesome. Those are very, very legit questions, Regina. Thank you so much for bringing those ones up here. The cost part, that's a very serious point when it comes to considering these things. And it's such important in a sense that we usually have trainings and presentations on their own about this matter. So this is such a short time that you can't even address the whole idea in 1 hour sitting like this. But to make it simple, there are many ways to go about it. So when you talk of cost, you're talking of premiums that you're going to have to pay for your policy. And these costs, they vary. They vary. There's no standard cost for a person. They vary depending on your age, depending on the amount you're taking, depending on your health condition, depending on your gender. There are lots of factors. So the ideal answer of knowing how much you're going to pay is to sit with your financial professional and run an illustration. The illustration is where we ask you those few quick questions that I just mentioned here. You know, your age, your preferred amount, some really basic things. And you mean even your interests. Are you interested in, cash accumulation, or you're interested in your, life protection? And that one gives the professional idea of how much you're going to have to pay, and they don't have to come up with it themselves. It's a software. It runs it right there, and then you get the numbers. And you even get to see how much of that money is going to grow over time and how much you can take out at any given time, maybe after 10, after 2, after 5, after 20 years. So yeah, the cost, yes, illustration, sit with your financial professional or whoever invited you here, or the agents in your area can help you there. Even we have folks here, if you're very new and squared onto this landscape here. And your second question was around new folks. Now, with new people who are just getting here, one of the basic requirements of getting an insurance policy here, you have to have a social security. If you have a social security and then you are working, you have an income, you have a relationship with a bank, that means basically you have a bank account where those premiums are going to be drawn from. If so to say, you have declared the taxes now that we're in tax seasons. So basically you have a legit standing in the economy. Even if you're here, you just got here for 1, 2, 3 years, you have a shot at this incredible product. Maybe my colleagues here would just open up their mics and add on. But to move to Munyanyera's question of living benefits and death benefits, that's a very legit one as well, because people only get to confuse it in IUL products. You can't get this in term policies or whole life. You just don't have much of that to even be confused about. But IUL is such great to the point that you get the living benefits. I know some of the other products of like whole life and stuff, they have something called living benefits. But in my experience with one of the careers, they define these living benefits differently. Some of them, like here, we just mentioned lots of categories of diseases: diabetes, cancer, all those chronic, critical, terminal illnesses are in living benefits. You're still able to get the money. But to answer your question as to the difference, the difference is that simple, the point that you can even catch it from the very words of those points that you just made. Death benefit, they pay it when you're dead. So basically you die and then you get paid when you're down, you're buried down. They pay you when you're dead. That's for real. The death benefit, you have to die to be paid. How are you going to get it when you're dead? I don't know. But they pay to your beneficiaries anyway. So they still call it death benefit. It's a payment anyway. You're dead, you're gone, but they still pay. They pay to your dependents, and it's good because your dependents, your wife, your kids, they are protected. But living benefits, it's a completely whole dynamic different from death benefit. You're still able to access that money when you're still alive yourself. You get sick, you catch that money. Remember on the colored slide that I showed you here, living benefits is on the yellow side. Death benefits is on the red side. So in a simple term, living benefits, you are able to get the money yourself when you're still living. Maybe you get sick, or chronically you're on a terminal sick bed, you're not gonna come back, or you're gonna come back, maybe you're disabled for a time being, you're not able to work, then you have a living benefit from your own money of life insurance. But if you remember that slide that I showed you, it's on different, completely different portions. Living benefits are on yellow. When you're talking of living benefits, we're talking about sickness. And when we talk of death benefit, we talk about death. You're now dead, and then your beneficiaries get to benefit that money. Those were all. I think pass it on to you back if you have to add on anything or take a few more questions if they're there.
Yeah, thank you so much, Herbert. That was actually great. So jumping here again, can you clarify the key differences between the whole life and the IUL?
Oh, good. Now, whole life is let me put it this way. Whole life is more conservative. It's a traditional vehicle. It goes up to 100 years. And it provides, in most cases, fixed interest rates. And usually those fixed, because they are guaranteed, they tend to be low. So you usually find yourself around 3-4% guaranteed, because the insurance company is committing in a situation where even when the market goes bad, they'll still pay the same interest. So it's very ideal for them and for you to, in a sense, get some guarantee. If the market goes up, they gain because you have a low interest rate. If the market goes way low, then you gain because they committed to that fixed rate. That's one level of how long they go, 100 years, how much they pay, low interest rates. And the death benefit tends to be a little lower than IUL. Now, with IUL or Index Universal, we talked about the downside protection. Because remember, the interest rate is not guaranteed all through. You get a guarantee on the floor where you can't go below. But they allow you to participate above the guarantee rate. So you'll find yourself where the guaranteed rate of IUL is way, way, way low. But that's way because they're going to allow you to participate above that guaranteed rate until you hit a cap. And actually, we have some vehicles that have no caps on interest rate. And you still have that protection right below there. And in terms of duration, IUL can go up to 120. Now, I don't know how many people are going to go over 100, but if you're lucky enough to hit over 100, then you're still covered. But with whole life, if you're blessed enough to go over 100 years of age, then the IUL says you're expired. Even when you're still alive, they can't cover you. So there are lots of differences in between there, but with IUL, there are lots of indexing the investment strategies, because they both have cash values, but the way they go about cash values completely different. Because one is invested with lots of dynamics, the other one is conservatively invested with a fixed payment.
And what's the difference in premiums on that note? Just a follow up.
So again, premiums vary. They vary for sure, because usually premiums of whole life tend to be more expensive because they have the guarantees that are relatively higher, because they're going to guarantee interest rate on somewhere around 4%. So if, say, you're buying maybe a policy of 100,000, you may find yourself in whole life you're paying maybe $10, and in IUL that could go down to $7. Because remember, there's a risk measure that is more likely to gain more. So they're not exactly different in terms of both what you get out of it, but also what you put in out of it, or rather into the policy itself, is different. So the exact way to measure the difference in the amount is an illustration. Once you run your age, you run how much you want, you run it in IUL path, and you run it in the whole life path, you see, or you can even say, with insurance, it's, I like the way there's dynamics. you can say, you know what, I want to fix the amount that I pay at $100. Let's see how much I get either in IUL or in whole life. So if you run $100 in IUL, maybe you get 110,000. And you run the same exact amount, $100 of payment in whole life, then you get maybe 95,000 of death benefit. That's before we even talk about investments of, growing your money and compounding it. It can get even more crazy different when it goes over time. If you get the idea of compound interest, then IUL becomes far much faster because you're getting interest on a higher rate and it gets compounded. Of course, at some point, it gets to a point where that dynamic gets to change, and over time, after maybe 20, 30 years, then you talk of the cost of insurance, the fees that you have to carry in there. But all those comes handy when you're running an illustration and get to see and look at those. And your financial professional should be able to sit you down, just like Ima says, look at your needs. Are you interested more in your protection? Then you can go even as conservative as a term policy, not even a whole life, which is way cheaper. Term policies are very, very, very cheap. 100,000 policy could cost you even like $2 or $1, $2, $3, depending on your age and whatever, how far you go, you are in life. But the ideal way is to sit with your financial planner and run those numbers for you and come up with your equilibrium point.
It looks like everything looks good. Mr. Speaker, if you have something else to add in conclusion, go ahead and make your final remarks. It looks like we're going to have to close.
I appreciate everyone's patience here. Thank you so much for asking very insightful questions, but even more so for being very attentive for this long. I think for those of you that will make it to the convention, remember to claim your few bucks that for those of you that passed the questions. I think Munyanyera and Sam, and yeah. Other than that, appreciate you all. Thank you and be blessed.
Have a good night, everyone. Look out for the recording for those who came in a little late. Have a great night, everyone.
Thank you.
Thank you.